Have you heard the talk about the debt ceiling? You know, the government, they're out of money and they are out of debt and they have to raise the debt ceiling again. You know, like every couple of years we hear about this. Well, when they raise the debt, they have to issue bonds. Now, when you understand the bond market, you can understand the rest of the markets. And today I am joined by none other than the self-proclaimed bond king of YouTube. That's right, my good buddy, Steven Van Metre. He's a self-proclaimed bond king. We are going to talk about what's going on in the bond markets, but more importantly, what that means for the rest of the markets. And even more specifically, what is likely to happen over the next couple of years. He gives us his forecast and even more importantly, how to play this, how to prepare. Also, I want to let you know that over the next couple of years, we are facing some very serious changes. As a matter of fact, you've probably heard about the Great Reset. By 2030, you'll own nothing, and so much more. Well, if you're not prepared to navigate this correctly, it could end up bad. That's why I'm having a live event. 15 of my good friends who are specializing in focusing on what happens over the next couple of years and how to survive it. Steven is one of the speakers, and he will be giving us his playbook, the playbook that I'll be probably using, and you should as well. Check out the live event down below. You don't want to miss it. Come hang out with me, Steven, and all the other guys there. It's going to be amazing. And with that, let's go ahead and jump right into the interview. Hey, everyone. Welcome to another episode of the Marcus Disruptor Show. And today I am joined again by my friend, Steven Van Metre. He's better known as the Bond King on YouTube. He makes videos, self-declared Bond King, we'll call it that. But man, he's a wealth of knowledge. Steven, thanks so much for joining us today.
Mark, always great to see you. Great to be back, my friend.
Yeah. So, man, you really made your name for yourself as the Bond King, but you talk about a lot of different stuff in the markets and you have a little bit of a different view than maybe I do. And so I always love to talk to you, get your perspective. So I'm excited to dig in here. Just tell us real quick, like what you're working on, like what you're focused on.
Yeah, I mean, right now, I kind of spend a lot of time looking at what the Federal Reserve is doing with quantitative easing and seeing how, QE tightens financial conditions, and without this fiscal stimulus that we know on the 6th of this month, the extended unemployment benefits went away. And you kind of look at the two, and a lot of people say, well, QE is inflationary. It really actually isn't until you get lending growth. But what's neat is we actually saw this fiscal assistance, maybe you could look at it as MMT, however you want to call it, but it really offset the negativity in the side of the monetary system that comes with QE. And so what's really neat for me now to look and say is, all right, is my view that we're going to see disinflation or deflation due to QE, is that going to start showing up more in the data now that this fiscal is gone? And so we're still too early in that, but I think in the next couple of weeks, we should start to see some early indicators. If the self-anointed Bond King is going to be right on his eventual call that bond prices are going to skyrocket as interest rates crash.
Well, I want to dig into a couple things there. But before we dig in, let's talk about that last piece you just said, the Bond King's call to see bonds skyrocket and then eventually crash. Walk us through what actually, so everybody sticks around. I'm going to have you answer that question last. So let's talk about something else. We're going to come back to that, everyone listening, so don't leave. We're going to talk about the dollar rallying, what's happening with gold and silver, the Fed, and a bunch of Evergrande, et cetera. But I want to ask you about the first part. So you watch like fiscal stimulus, what the Fed's doing. And it seems that like, you also mentioned like indicators. So we have like indicators and we can see what's happening in the markets and then we can kind of try to gauge or guess where they're going to be. But it seems like right now, everything's being driven by Fed policy. I know there's a Fed meeting coming up tomorrow at the time of this recording, but we don't know what's in their head. And it seems like that's what's driving the entire market. So how do you balance that? Hey, hold up just for a second. I want to tell you about something. I just got something cool in the mail I want to show you. And it is this new sleek package I just got with a brand new credit card. This isn't just any credit card. This is a BlockFi credit card that's powered by Visa and it's backed by Bitcoin reward. So this is a Visa card. I can use it anywhere in the world that Visa is accepted. And the benefit of this BlockFi Visa card is that I get paid back in Bitcoin. Most of my other cards pay me in some sort of reward points. I get airline miles. I'm not very good at using those. They end up accumulating and I don't do anything with them. But getting to earn Bitcoin back with every single purchase is of course something that matters to me. Now, I know for a lot of people, they say that the price of Bitcoin is too high. So I say, well, you can always earn Bitcoin. You can get paid in Bitcoin, or you can just get cash back rewards on every purchase, paid in Bitcoin with the BlockFi Visa credit card, used everywhere that Visa is accepted. And if you want to sign up for the Visa card that pays back in Bitcoin from BlockFi, there is a link in the description down below. Check it out.
Yeah, it's kind of interesting because you look at the situation of the FOMC board. You have the president, Jerome Powell, and the vice chair. They are the chairman. I guess he's not the president, the chairman and the vice chair. They're the two most powerful people. They get what they want. The other members of the board do have a say. And so the big question is Powell going to keep his job? And then is he going to taper the balance sheet? And my view is he's going to hold his job because the Biden administration is really running out of time to say he's out. I think maybe we've got another month, maybe at best, before they have to say, hey, he's not coming back, and we're going to begin our search for a new Fed chair, which the person that likely would take his seat is already on the FOMC board. But we do know
is that Brainerd?
Yeah, from Brainerd, and so we do know from everything that Powell said, not only in his press conferences, but in his speeches, we know this from Jackson Hole, that he does not want to taper. He actually really believes, in fact, there's a piece in the Jackson Hole speech where it appears that he's talking to the general public, but he's actually really talking to the other members of the FOMC board, where he actually tells them, look, the data is lagged. We know the data lags. And if we start tapering too soon, we could find ourselves on the wrong side of this, and we need to give it more time. Mm-hmm. And the other reason I think he doesn't want to taper is because that could be a quick way to be out of a job. If he starts tapering and then the economy rolls over, what is the Biden administration going to do? What do they politically have to do? And a lot of people don't understand that there are political motivations here. If he tapers and the economy rolls over, that it's likely doing anyways, he's going to take the blame. And it would be every right for the Biden administration to have him as a scapegoat and say, hey, look, he tapered, shouldn't have done it. He's gone. And no, I don't think that's what happens. I think Powell wants to stay on because he's already rich. And, a lot of people don't understand. I think the guy's net worth is over $100 million. But he is now one of the most powerful people in the world. So he wants to continue being Fed chair, and he wants to continue QE. And I don't know what he's going to do exactly at this meeting tomorrow, but I have a hunch that he's going to push this as far out as he can. And we've heard him suggest that perhaps early next year, which at that point he would be safe from an employment standpoint. So we'll see if he gets enough pressure, or if the data and his power as the chairman can push the other board members to hold off a few more months and then let the data roll over, and then he'll step back and say, see, this is why I'm still the chairman.
Yeah. But do you think, instead of just looking at markets and indicators and trying to guess what's going to happen, now it's like trying to guess what the Fed's going to do? And I guess you're looking at the markets to see what the Fed may decide to do based off of that, but it's still a guessing game in their head, right?
Yeah, one thing I like is if we're focused on the consumer price index, if the metric of the Fed doing something is indeed inflation, the best thing to look at is the year-over-year rate of change in crude oil, because it leads the CPI. It's probably one of the best metrics. It's not perfect, but if you're going to pick something and said, I'm going to stick by that, I'll go with it. Well, the year-over-year comp of crude oil is way down. And if crude oil just holds where it's at in the low 70s or high 60s, in the next 3 months, the year-over-year comp is going to start going down again, because you look back a year ago, it flat lines, and the crude oil starts going up. So all Powell's got to do is just hold out long enough. And if that relationship holds true, then we should see the year-over-year change in the consumer price index be peaking now and heading lower. And then all of a sudden he's validated.
Now, I've talked about CPI extensively on my channel, and I call it a political tool. They've revamped the way they calculate CPI many times in the 80s, the 90s, et cetera. And it seems like they're trying to show the number they want to show to push their own agenda. The CPI doesn't really seem to cover all the things that we need today. So why is that CPI number so important when it seems like most people realize that's not the actual number?
Well, it depends on what your view of that is. I mean, the CPI does an actual relatively respectable, decent job of what they're trying to do. The issue people have is that it took out home price inflation, and instead they use rent equivalent. That's just an opinion on which is more valuable. But if you look at what the Fed or what the BLS is trying to do in terms of gauge consumer prices, they actually do as good a job as anything. Now, the issue people have is how they construct it and say, well, how they weight it. But their job of actually going out to the market and identifying where prices are moving, it's good. And it's a really difficult job to do. I mean, if you tried to say, hey, how is Steve spending versus Mark, you're spending? Well, they're going to be different. And the idea that we can create one metric that accomplishes from people that are worth 100 billion down to have, a negative net worth and incomes across that, it's not possible.
Right.
It's just not possible. So it is a challenge. But I think the BLS, of all the things that they do, that's the one I'm probably the least critical about. And the Fed does have the PCE, and they have some other metrics that they try to gauge inflation. So they actually don't use the CPI specifically. They use personal consumption expenditures, which is more coming out of the factory prices. But yeah, it's just really difficult.
Yeah. And to your point, I mean, talking about inflation is a very nuanced discussion. I mean, first off, you have like asset inflation versus like goods and services inflation, but then it affects us each differently. So like a guy living at home in his parents' basement, watching Netflix and eating takeout, his CPI is different than someone who wants to buy a house or someone who's trying to pay for their kids' medical bills or go to college. So it does affect us all differently. I guess it just is, like I said, they've continued to change it. They've done substitutions. So now instead of steak, you get hamburger meat, for example. They've taken energy out, which is like a big piece of it. The rent equivalent, of course, and then we have the rents being suppressed because of rent eviction moratoriums, things like that. So I don't know. It just seems like it's not really an accurate number, especially when it seems like people go, well, gas is up 47%. Everybody needs gas. Now, if you're commuting for work.
CPI. Energy is in the CPI. Now, you might be thinking of the core, which excludes food and energy, but the base CPI does have it.
Right.
And so again, it's if you don't drive much, right? Then like I have an electric car.
Yeah.
So how much
I work from home,
right? It doesn't affect me at all. But someone who say commutes 50, 60 miles a day, well, it's going to have a massive impact. Now, are we equal? No.
Yeah. Yeah, no, you're absolutely right. That's why it's so nuanced. Now, back to the Powell thing, and this is just speculation. We both mentioned Brainerd. It seems like I've seen like this mounting opposition, maybe from some of the maybe more radical side of the left party, AOC and whatnot, that they want someone that can really come in and be more aggressive in regards to ESG type things, environmental things. Have you seen talks of that ramping up?
A little. Most of what I've seen is they want to crack down on the banks. In fact, you might have seen Pelosi say she wants the Fed to break up Wells Fargo. I don't know if you caught that recently. The real issue is that Powell is a friend of the banks, and Congress wants someone to come in and crack some knuckles and break the banks up or be stricter with the rules, and Powell's not going to do that. He understands that the way money is created in our financial system is through the banks. And as you know, because I know you talk about on this show, they're not really doing that now. We've got all these shadow banking systems that are actually doing most of the lending. So if you look at the banking system now, it's mainly just a place for people to deposit money. Yeah. And they do some lending, but not what we need. And that's because we keep piling more and more regulations on banks. And we do that for one very specific reason. We need a dumping ground for all this US Treasury debt we're creating. Well, how do you create a market for that? Well, you go to the banks and say, oh, by the way, there's a new regulation today that says if you have this on your books, you need to back it with X number of treasuries. And the banks are like, oh, great. Well, if we start taking that ability away, then who's going to buy up all this debt?
Yeah. Yeah. Now, at the time of this recording on 9/21, we're like 2 days into like some red days across the market where pretty much everything is down. It's kind of red. I'm curious, we have this is the day before the Fed meeting, and of course we're speculating at this point. By the time this airs, we'll find out if we were right or wrong. But potentially people were thinking the Fed might announced tapering, which some people speculate that maybe that's what's causing some of the sell-off to happen because the Feds are tapering. But I'm just curious, if the market starts selling off in anticipation of them announcing that, do you think that changes what they may decide to announce?
Right. Well, that's kind of the double-edged side of the sword. Is there's belief that, okay, there's going to be an announcement of a taper starting in November. It's going to be fairly aggressive. Oh, but due to Evergrande and a market sell-off, there's no way they're going to do it. And
right.
It's kind of weird that we think about things that the Fed is looking that closely at the markets and making a decision. We do know that there's one thing the Fed does look at, and then Powell was very clear about this in his Jackson Hole speech, is, hey, we think we've accomplished our inflation goal. We know we've overrun it, but we think it comes back down. And when it comes down, it's going to hit our long-term trend. Okay, maybe we'll see. But historically, and what he was clear about is we're not at full employment yet. And if you go back and look at Fed policies, they never, ever tighten until we're back at full employment, where every job lost is back. Now, maybe by November, magically all those jobs will be back. I don't know if that's possible, but from that standpoint, we say the Fed doesn't do anything. And I think Powell knows that he needs to keep conditions easier for longer. The only question is, can he convince the rest of the board? And again, he's really powerful. So they ultimately will fall in line with what he wants.
Yeah, that's a good point. I mean, I do remember I actually commented about that on the video. So for everybody listening, if you're not sure what Steven's talking about, the Fed has basically a dual mandate. They're trying to expand those now, but their mandate is to have full employment. And of course, we haven't got anywhere close back to where we were pre-pandemic levels. And so, it kind of seems like if that's their mandate, why would they let off now if they need to keep getting to that point?
Right. I mean, we have almost 11 million job openings according to the government. Now, if you want to talk about something I don't think is legitimate survey, I think that one is one of them for sure. The other side is you've got 7.5 million people who are now off all forms of unemployment benefits, and we had a total of 12 million people on benefits. So we still have some people on it. The question really is how fast do those alleged $11 million jobs get filled by all these people? Or are all those jobs bogus and they're not filled? To me, that is really a big question. If everyone want to know, what are you looking at week to week? What am I really interested in right now? It's initial unemployment claims. That number should be significantly smaller. In a healthy economy, it should be around 200,000 a week. It has been trending in the low 300s lately, but that's still way too high and for normal conditions. So if that is the bottom around 330,000 and starts going back up, all bets are off. Economy is rolling over, double dip recession. And if that number keeps there, it's telling us that these people are not going back to work, which then begs the question, are those jobs really there? There's a lot of questions right now of how fast this thing can roll over.
I can tell you from personal experience, since the summer, I've been traveling a lot because every conferences are going again. I mean, I've been all over the country and the world even, but mostly around the country where I've been literally boots on the ground in the big cities, in Miami, in Orlando, in Dallas, in Phoenix. Everywhere I've been, the hotels are understaffed. They can't do room service at all, limited housekeeping. Some of the restaurants can't open. The bars only open 2 hours a day. The restaurants are running at limited capacity, all because of staff oversight or shortings. And I mean, that's just my take, but I hear the same thing from lots of other people. And then that also dominoes because now those businesses can't make near the amount of money that they should be making.
Mm-hmm. Yeah. So, I mean, I've traveled a little bit and I've experienced for certainly some of that as well. But yet you look around and you see all these, places there. You look in the survey data, it keeps saying employers can't find people. So,
right. Well, because the people don't want to work.
Well, so that's the question. Now that they have no income, are they all going back to work or not? And that's where the initial claims will be interesting, because if I'm an employer and I'm still turning over employees at the same time I'm trying to get employees, then it tells you there's something fundamentally wrong with the economy. And I think there actually is. And I think we're going to find out over the next couple of weeks that, yeah, they're either, hey, this all worked and everyone's going back to work and normal is coming, or no, there are actual structural problems that existed before the pandemic that have now been made worse due to the pandemic.
Yeah.
And we're going to head into a double dip recession where the Feds already got the gas pedal on this easing thing down pretty hard. They don't have a lot more latitude to go.
Yeah. Well, I'm going with option number 2. We'll see what happens with that. So we're 2 days in at the time of this recording into this, in the market seeing red. So maybe in anticipation of the Feds trying to pull back. The other big news is, of course, Evergrande. I know you've been covering that quite extensively. I talked with Greg Foss about that a little bit the other day. But that's big news in China. And it seems like, I think I saw today or yesterday, another big maybe home builder in China is also selling off pretty bad, at least on the equity side. I know you've covered it quite extensively. Why don't you kind of give us a high level view of that situation?
Yeah, so where this all started is China had rampant property value that were just rising out of control. And China's view is we got a lot of people we want to put into a lot of properties, and we can't have prices spiraling out of control. At the same time, people that could afford to speculate, and as you remember from the great financial crisis, hey, there were people out before that buying, they didn't have one home, they had 10, and they'd roll equity from one into a loan and another because it was, hey, there's all this demand. So if you're well-to-do enough in China where you can get loans to buy more properties, knowing there's all these people coming to buy them, you can make some money. Well, in a planned economy, that can only go for so long before the government steps in and says, hey, all this speculation is going to come to an end because these prices are too high for the people that we need to get in these properties. So they put some curbs on it, and they tap the brakes. And what we found out is that companies like Evergrande, which is either the second or largest property developer in China, has got an extremely large amount of leverage. And effectively, they're selling properties that aren't even finished yet. So people are buying unfinished properties, knowing that, okay, in 6 months, a year, whenever it's going to be done, I'm gonna move in, but I'm gonna buy today. And they're taking that money and they're using it to pay the interest and debt service their debt. And effectively,
kind of like a Ponzi scheme.
Exactly exactly looked like a Ponzi scheme. And what's interesting to me is just a light tapping of the brakes. I mean, Beijing didn't do a lot. It's not like they said full stop, this is all coming in. They just tapped on the brakes and said, look, we want to curb the speculation a bit. And all of a sudden you find out this massive property developer is effectively running a Ponzi scheme. And so the contagion is if one of the biggest ones in the world is doing this, then what is everybody else doing? And that's where we get these Lehman-like events. Evergrande is not a bank, but the risk is, Lehman failed, and then we thought there was nothing else. And then Bear Stearns went, and then we're like, oh, wow, okay, now we got some problems. That's the question is this a domino of one after another because they're all taking risk?
Yeah. And aren't we seeing another big one that's going down today? The equity is dropping off a cliff.
Yes. Well, part of the problem is China is closed Monday and Tuesday for a holiday. So we'll see tonight when they start to reopen. There's some belief that Beijing is going to bail out Evergrande, but they're a private company and a lot of their debt is junk or high yield. It's out in the marketplace. So I don't know how they would directly come in and bail them out. Now, some people say, they just need to devalue the yuan. Great, go ahead and do that because as we're finding out, Evergrande borrowed a lot of money in dollars. So if you devalue your currency, their debt service costs are now going up even more. But we do know Evergrande has already missed some payments, and on Thursday, which will be after before the show airs, is that they're got some more payments coming up. We don't know what's going to happen, but what can Beijing do at this point? Well, all they can do is force the banks to restructure the loans. I mean, they can do that. They can walk in and say, look, we understand this is what you think you're going to get. This is what you're actually going to get. And it doesn't mean they're going to take a haircut. It just means that, hey, you might get paid over a longer period of time. And in the meantime, what is Evergrande doing is paying people I mean, and I know you were in real estate development at one point, Mark. So can you imagine, right, that your property that you're renovating is failing. You ran out of money, and so you pay your contractors an unfinished property. I mean, like, what are they going to do, right? I mean, it makes no sense, but Evergrande is actually paying contractors and people in unfinished properties.
Yeah. And I think the bigger problem too is, I like to look at even a bigger macro picture. So even like what's going on politically and so forth. And we're kind of at this point where we're in this 250-year revolution cycle that's like hitting right now. And we're seeing all across the world, like the centralization keeps growing, but we're seeing populist uprising all across the world, millions of people in Brazil, et cetera. And China is having a pretty big problem. They're really trying to control that civil unrest like most nations are. And I think they're really concerned about this Evergrande blowing up and then all the people losing their money, because Evergrande moved into like financial services and things like this. And if they go bust, then all those millions of people go broke. And then China has a serious problem on their hands. So I would guess they're probably going to tell the bankers to take a haircut and let the people get whole, which could be very expensive.
Yeah. I mean, at one point, Evergrande actually went to their employees and said, either you loan us money or we're not going to pay you your bonus. And apparently the employees went to their family, their friends, and other people and loaned the company money. And, I think I mentioned on my show, look, here's a pro tip. If the company you work for says, we're not going to give you a bonus unless you lend us money, they don't have any money. Yeah. You better probably start looking for another job, because let me tell you what's coming next. Yeah. And people did it because the interest rates were high. And it's like, but that's, again, there's an element of risk. The question is, does Beijing want to teach people a lesson here and say, look, you're being stupid? Are they going to bail them out? We don't really know. But so far, the answer has been, we're going to force a restructure of the loans. Now, what does that mean to those who are owed money? Well, it means they're going to get their money back over a longer period of time.
Yeah. I've seen people throwing around, like you kind of already referenced, like Evergrande's kind of like the Lehman Brothers, 2008. They talked about I don't remember off the top of my head, 3 times bigger or 5 times bigger than Lehman was at that point. I saw that, I think maybe it was a tweet this morning, and I was going to go look it up, but I haven't had time. But it's way bigger than Lehman, but also the financial market's way bigger than it was in 2008 as well. Do you have any idea what that reference is?
Yeah, I think people are just trying to compare the two, and it's not a very good comparison, because one, you have a bank as one as you have a property developer. And I think the best way to interpret it is when Lehman Brothers fell, the market tanked, and then it rallied back because everyone thought it was a one-off event. And then Bear Stearns showed up, and then boom, great financial crisis, everything's blown apart. Right. I think people are looking at Evergrande and saying, is this a one-off event? My guess is it probably isn't, and we don't quite know that yet.
It isn't or is?
We don't know. I don't think it is, because if you're the leader, right? If you're the largest or second largest property developer, and how do your competitors keep playing with you, right? I mean, if you're competing with them as a property developer and they're effectively running a Ponzi scheme, how are you running a profitable enterprise unless you're doing the same thing? So my guess is there's, where there's one cockroach, there's probably another. And I think that's the question is there a cascading effect in the China real estate market? Because real estate there is 25% of GDP. If that blows up, there goes China's economy, there goes the world. And I think that's what people are, that's the question is it a one-off event, or is it Lehman Brothers leads to Bear Stearns?
Well, I think, I'm not an expert in China, but for years and years and years, I've heard about them building ghost cities. I mean, entire cities that are empty, building roads and bridges to nowhere. I've seen videos of these entire cities that have nobody living there, no infrastructure, no services, et cetera. And all the shoddy construction everywhere. I've seen videos of that. And so if you take into consideration all these potential ghost cities they have and roads and bridges to nowhere, and now you layer on this potential cascading effect of these home builders, I mean, it could be catastrophic.
Absolutely. I mean, and that is the question, because you look at this debt and a lot of people are like, oh, well, all the debt's held in China. No, not necessarily. There are other banks that have this. And when you have a debt downgrade and you're a bank, under the Basel III banking regulations, that means you've got to hold more collateral against it. And that is usually some form of government debt or cash. And so that means the banks have to hold more, and that means they're going to lend less. And then no doubt that some of the stuff is infiltrated investment products all over the world. Well, that means, those companies are going to take a hit. So, we're in this global economy, and the risk is that one domino falls, there's probably more. And the only question then is, how far out does this really go? And I think you and I have a hunch that it probably goes fairly deep, and everyone's hoping it's not, but it probably is.
Yeah. When there's cockroaches, when there's smoke, there's fire, kind of a thing. So it's going to be interesting to see if they can contain that. But so maybe it's that, maybe it's the Fed meeting, maybe the markets are selling off for no reason. But for the last, at least for right now, it seems like the dollar's been rallying. It's been kind of staging a rally. I know you've been talking about that quite a bit. Does the dollar rally at a time when a country like China seems to be falling behind? Do you think those are coordinated, or what's going on with the dollar?
I just wanted to take a second to explain to you one more time just how cool having this new BlockFi Visa credit card is. I've started to move a lot of my bills over to get paid from this. Of course, all my business supplies, I'm starting to pay for this, my advertising budgets, and I'm starting to run as much as I can through it because I'm getting paid a percentage back of every single transaction in Bitcoin. We want to save in Bitcoin because Bitcoin is an asset that goes up in value because of the deflationary nature of it. And we want to spend our fiat. So I'm spending my fiat through my BlockFi Visa card, and I'm getting back Bitcoin that I can save and I can hold. I expect it to go up in value a lot. I expect to hold my Bitcoin. I'm going to pass it to my kids and my grandkids, and hopefully my great grandkids will have my Bitcoin one day. So I'm going to save it. I'm going to spend my fiat through this card, and I'm going to earn back Bitcoin that I'm going to save. If you want to get one, there's a link down below.
Well, yeah, especially if you've got a company like Evergrande that has dollar-denominated debts, in which they were betting on a weaker dollar to have lower debt service payments. So dollars going up. And why is the dollar rallying? I wouldn't say it's rallying yet, but it's setting up. If you're a technical analyst and you like to look at charts, it's hard to not look at that and say there's a big bottom forming in the dollar. And it's because what quantitative easing does is it traps dollars in the financial system, in the commercial banking system, and it limits their mobility. And so right now, two of the major banks that have received stimulus money are Bank of America and JP Morgan Chase. Now, Wells Fargo got some, but due to the penalties from the Fed, Wells Fargo's been capped at how big it can grow. So you have all this money flooding the commercial banking system. It's locked down there. It can't move. And what that does is it leads to a stronger dollar. So over time, the longer the Fed does QE, the more likely the dollar is to gain strength. And then you take in the fact that, okay, how did we offset that? Well, we borrowed money and gave it to people. Well, that's all gone now. I mean,
right.
They're still doing the child tax credits, a little bit of an increase, but it's not, as much as directly giving people money as we did before. And so now the question is the market weakness we're really seeing? Is it because all these people were getting extra money and speculating on stocks, and now that money's dried up? Is it because the fiscal stimulus is gone and QE is finally really starting to dig its teeth in? But I do expect the dollar to go higher. I mean, if you look at what the government bonds are the form of deferred dollars. So if you see bonds heading higher, then you're likely going to see the dollar follow it. And bonds have been slowly moving up. And well, that would make sense. The dollar is going to follow it. And that is a bad situation because there's a lot of dollar denominated debts out there. We have a lot of people that are now unemployed, not on any form of government support. And the only question is, what does that do? It creates dollar demand, and that means dollar goes higher and there's more pain coming.
So when the Fed does the QE and they put the reserves into the bank balances, which most people consider that printing money, but it doesn't actually get into the market because it can sit in the banks. That's the kind of the case that you're making. So the banks sit on those reserves. They don't do anything. But at the same time, it does seem to have pushed asset prices higher. We've seen that since 2008. So, I mean, there is some effect. I would just think that the bank creating the QE would be, show a sign of weakness. You would think creating more money, monetary base, even though maybe it hasn't got out to the individual people, it would create the dollar weakness. But you're saying that it actually is creating dollar strength? Yeah.
I mean, if you look at, so what is the goal of quantitative easing? I mean, it is to lower interest rates to spur lending growth. Well, as a global reserve currency, so you have to think of how the dollar plays into it. What would it take for me, as an American, to spend my money in a foreign country? Would a weaker dollar or a stronger dollar do that? Well, a weaker dollar wouldn't.
Weaker dollar.
Because why would I go buy that foreign car, take that foreign vacation when I can buy a domestic built car, or travel here and it'd be cheaper? So if you look at what QE is doing by trapping reserves in the banking system, and it's important that even though these reserves are shown on the bank balance sheet, they're actually held at Federal Reserve member banks. So the banks can't move them. They're used to settle intrabank settlement or settle intrabank transfers overnight, but the banks do not have control of them. They're property of the Fed, and that's real key. So if you look at what the Fed's trying to do, if they were lowering interest rates and weakening the dollar, they're offsetting each other. That doesn't make any sense. So what really QE is trying to do is lower rates and raise the dollar, because then now you think about it. So I've always dreamed about, say, buying that, German super sedan, right? One with all the badges and the big turbos and all that. Well, if rates are low and the dollar's strong, that lease payment on that car that I can't afford is now attractive enough that I can do it. And what happens then? Dollars get out of the US into the foreign economy where they can multiply, and that's what you need as a world reserve currency. You need dollars to cycle. So if you have a weak currency as a reserve, it doesn't work that way. So absolutely the dollar needs to go higher. And even though people do look at the monetary base and think that the Fed magically raises asset prices, we'll see how well that works during the next recession when asset prices do come down. But I think it's more coincidental than it is an actual relationship. We'll see.
Maybe it's only the asset prices that they were buying, insider.
It could be, but yeah, again, the Fed only buys what? Treasuries. But
I was talking about how they bought these positions and now they got that discipline.
You're right. You mean the Fed, right? But if you think about how QE is driving asset prices, it's not that the Fed purchases bonds and magically my house goes up in value, the stock market goes up in value. What is the transmission mechanism? Rates go down, so you look at what's driving the stock market. It's margin debt. I mean, margin has exploded to ridiculous record all-time highs. Why?
Right.
The banks are like, well, we can lend money out. People will go and buy stocks, and that drives the market higher. Now, can you tie that back to QE? Yes, because QE drives rates lower. But does QE cause stock prices to go up? No, it doesn't directly make anything go up. The only question is, how does that money get borrowed at those rates, and where does it go? Well, it's gone into housing and the stock market, but not directly from QE.
Yeah, but I mean, if rates go down and lending's more attractive, then that happens. We've seen over the last several years. I mean, the stock buybacks, for example, went through the roof, which of course then pushes the stock prices up. So that's coming from QE pushing rates down.
Right, but it's not QE itself. There's people out there that believe that when the Fed buys bonds, stocks just go up.
It's like a 1-to-1. Yeah.
Right. There's always an intermediary step, whether it's a corporation borrowing money or investors borrowing money. In the end of the day, we as people have to decide if we're going to borrow money and where we're going to spend it. If we use that in bicycles, then bicycle prices would explode. I mean, It all just depends. It just so happens that it's being borrowed to buy stocks. And so, yes, is the Fed deliberately raising stock prices? No, but they're indirectly raising them. Now, that doesn't mean that QE can cause an indefinite increase in asset prices. And I think that's what will shock people, is that lower rates tighten financial conditions, and they don't really understand that. They now believe that as long as rates go down, which they don't understand that rates went down during the financial crisis too, and so did stocks, that you get an infinitely higher asset prices. I don't think that happens. I think we find out that QE really doesn't do what everyone thinks, but we're not there yet. They still think that's to come.
Yeah. Well, one thing that it may seem something else that's moving, I know you've been talking about quite a bit, is gold and silver. Maybe that's being driven by the bond rates, the interest rates. I think it's driven by real rates. Whatever's happening, gold and silver sure are seeming to be struggling at a time when it seems like the Fed needs some inflation, so that you almost think that per kind of like what Luke Grauman says, like you'd almost want to see gold traveling higher to help get some of that inflation. I know you've done a couple of videos on that. So what's your take on that relationship right now?
Yeah, it's funny that everyone thinks the Fed can create inflation, but they have a pretty poor history of doing that.
If they really wanted to, they probably could, but yeah.
Well, I don't think they have the tools to, actually. I mean, if they're
because they'd have to get money directly out to the people.
Right. I mean, they have two policy tools, the federal funds rate and they have QE. They both do the same thing, and which is lower or raise rates. The Fed doesn't have the ability to print money. The federal government doesn't have the ability to print money. Right. Now, obviously, the laws could be changed if Congress wanted to do that. But yeah, if you look at gold and silver and you look at yields, the first thing you notice is when yields start to go down, it's an indication that financial conditions are tight. Now, this is something we learned from Milton Friedman's research. Now, the only way that lower interest rates lead to higher interest rates and inflation is if they go down and they spur lending growth, and we're not seeing that happen right now. So what then happens is as financial conditions tighten, for whatever reason, commodities are the next to follow. And you usually start to see that in the precious metals, in gold and silver. You'll see that in copper, crude usually, but right now due to the pandemic, I mean, we're seeing these weird pandemic things show up. So crude's holding higher because there's obviously a shortage in products right now. But nevertheless, you see yields start to go down, then you see commodities, and then you'll see eventually the stock market's the last one to figure it out. Emerging markets is another great signal. You start to see weakness there. And it's all indication of a dollar shortage. Well, that's exactly what QE does. In fact, we could almost argue is QE part of the problem of what's going on with Evergrande? Is China's little tapping on the brakes, was that really a big deal? Or is it just bringing to our view that, oh, there's a massive dollar shortage? So yeah, I do expect gold and silver to go lower, and then there'll be a point where I become a massive gold and silver bull, but I still remain bearish on that due to their likeliness that I think yields go down, but I also think the consumer price index is going to go lower and go negative like it did in the GFC, where you'll see real rates skyrocket, and I don't think anyone's expecting that. Wow.
So short-term bearish, long-term bullish.
Correct.
Yeah. It seems like, I mean, given where we're at, and there's it seems like the Fed's kind of in this rock and a hard place. And, since 2008, they've been pumping QE. When they tried to taper it, we saw the markets sell off in, 18, 19, and then they've been pumping it back up again. Everyone says, well, they can't really raise rates, nothing meaningful because there's so much debt and they need to keep borrowing more. So could they raise rates? Maybe 0.25% or something, not meaningful. And then how can they really taper? Even when they said, we're not thinking about, and then they changed to, we're thinking about maybe in a couple of years, that was enough to cause the market to sell off. So it seems to me that realistically, there's just no way to meaningfully taper or raise rates. What's your take on that?
100% agree. They are stuck in a rock and a hard place because they really actually should be not only just tapering, but they should be doing QT. They should be unwinding their balance sheet, because what's really weird is quantitative easing oddly causes cash to start building up in the banking system. Now, it's not because QE prints money. It's because QE lowers rates so far that savers look at their options of saving, which they try to earn the highest yield on their savings, and realize it's a negligible amount of interest to tie their money up for 2, 3, 5 years or whatever it is. So they just start saving cash. Well, then cash starts building up, which drives the front end of the curve down and almost went briefly negative twice, which we can't have. So now the Fed has to come in and say, well, wait a minute, time out. Can't have this happen. We'll do this overnight reverse repo to suck up all this cash that we're not really sure where it's coming from, but it's probably fiscal stimulus. Well, it is fiscal stimulus. It's also due to QE. So what should the Fed be doing is they should be unloading their balance sheet like crazy, trying to drive rates up to get all this cash that's sitting in cash into the actual financial system. But what do we end up doing? We're doing, it's literally a dog like chasing his tail. More QE, cash problem, more repo, more QE, cash problem, repo. And the answer is to get out of it. But if you think about why they can't, because it's simple. Well, why don't they just do a bunch of quantitative tightening? Why don't they just raise federal funds rate to 5%? Great. You want to know how fast the economy will crash? So they've got literally a lose-lose situation here. The only option is to continue going and hope something good happens.
Yeah. So what they hope, per their, Keynesian economic worldview, is that we could grow ourselves out of this eventually. Per the Keynesian multiplier, once we get past like 90% debt to GDP, that doesn't really seem to pay off. Of course, we're way past that. But even worse than that, I look at something, I talk a lot about Bitcoin and cryptocurrencies. And the one thing that's super alarming to me, Gensler was out talking today or yesterday with the Washington Post, and talking about cryptocurrency stablecoins. But the big thing that I see is that if you look at the situation we're in right now, like most of our growth over the last 20 years has come from the internet, right? It's the FANG stocks, et cetera. The United States has been the world leader there. And so we innovated and we were able to grow, although we didn't really grow out of the debt, but it spurred all this economic growth. And today we have another technological revolution that's even bigger than the internet. But they're trying to pump the brakes on it. I mean, they're trying to shut it down. And that's really concerning because it doesn't stop the technology. It just pushes it offshore. And the only hope that we'd have to maybe, hopefully, cross our fingers, grow our way out of this would be to have something that big that the U.S. could own. Have you been paying attention to that at all?
Yeah, I think what the bigger issue is I don't think the United States seems to care, or government cares a whole lot about crypto as much as they care about the fact that they need to regulate it and they need to tax it. So you look at Tesla. Remember, there was a brief period they came out and said, "Hey, we'll sell you a car in Bitcoin." Mm-hmm. Cool. And then all of a sudden, I don't remember how long later, yeah, you know what? Yeah, we're not going to be able to do that. And there was really no explanation, except I'll bet what actually happened is someone from the IRS called up Tesla and was like, "Oh, by the way, we want to know all the details on each person that transacts that because we're going after them for capital gains." And right. I think that's the problem the government's got right now is they can't tax it. And so, yeah, they need to regulate it so they can tax it. But are they threatened by it? I don't think they're threatened by it at all. I just think their issue is they can't tax it. Or they haven't got an effective way to do it yet. But when they can, then they won't care.
Yeah, well, I think what they've really been unhappy about, or maybe it's just the banking industry, is I think all these peer-to-peer lending markets that have opened up where people can make 6%, 7%, 8%, and all that money's leaving banks and going to these platforms. And so Yellen, Elizabeth Warren specifically, and Gensler, they've been coming after that like full guns blazing. Warren said, "I have an idea. We can just ban the banks from participating." That's exactly what she said. And then today, Gensler, I don't know if it was today that he talked to Washington Post or it was yesterday, and he was saying that the SEC has a lot of tools and we intend to use them. But what would be better is if these companies would come to us first and have us pre-approve a plan where they could work within our parameters that we want. Like if the Wright brothers would have gone and asked for permission to build a plane and fly it, it never would have happened. They said now they want to run it through Congress. So imagine a tech company trying to innovate and have to go to the SEC and get approval and then go through Congress. Like, how is that going to work? And so the internet, for those that maybe don't know the history, the internet was almost stifled. And they actually passed a bill, Section 201, that allowed it to have the freedom to grow. And unless we see something like that, anyway, the debt to income ratio is already in a bad situation. And unless a miracle happens, it's probably we're not going to grow out of it. And if we stifle this, it just seems like it's even less likely. We'll see.
Yeah, there's one thing that I'll disagree with you on, and that is I think the banks would love it if people took their money out because the banks are being penalized due to all this cash under all these regulations, and there's nowhere for it to go. So
that's true.
I think you look at Wells Fargo. I mean, I bank at Wells Fargo, and not that I love them particularly more than any other bank, but they're stuck. I mean, you look at their position is they want cash out because they're capped. They're regulated so hard that if they get more cash, it's more penalties. You look at JP Morgan, they said, we want to get our cash flows down because we're paying these ridiculous penalties. I think they'd love it. If people took all their money and went into the crypto exchanges and were able to earn interest, I don't think the banks would care much. Now, over the longer term, okay, I might agree with you there that, hey, that would be an issue. In the short term, right now, what do the banks care most about is buying their shares back and getting those penalties down so they can buy more of their shares back and enrich their executives. And that's...
No, you're right about that. We've even seen some of the banks over in Europe and like Germany specifically, they don't want the cash. They won't even take it. So you are right about that. But I guess just in regards to, can we grow our way out of this? It's slim to none. And if we stifle innovation, it's going to be impossible. So with that being said, what is the bond king forecast that we were talking about at the beginning? So bond rates are going to skyrocket, then they're going to crash.
No. I think bond prices are going to go up, and then interest. And do the inverse relationship. You'll see inverse.
So the yields drop.
Yields crash, and that will largely be due to the economy rolling over and heading lower. The Fed not tapering. In fact, the Fed will be back with a lot more QE, and they'll be buying it at the intermediate and long end of the curve because there's a shortage in T-bills. I know you're aware of that, and I know your fans are as well. And that will hammer the long end of the curve down and send the long end of bond prices rising. It'll tighten financial conditions. It'll be a massive risk-off event. Risk assets will crash, and it'll be a rare opportunity to unload bonds at a very high price into the Fed, while buying risk assets on the cheap as everyone panics because things didn't work out.
Yeah. I'm guessing you do watch the CDS market, the credit default swap market, quite a bit on those as well. Are you watching? No, you don't? No. You don't care about that?
Nope.
Because it seems like the bond market is pretty much captured. It's something like the Fed's buying 85% of issuance or something like that. So like that's a pretty manipulated market. But if you look at the credit default swap market, people actually buying insurance against it. It seems like maybe it's a little bit more of an open market.
Well, the Fed's only buying mortgage-backed and treasuries right now. In fact, they've completely unwound their corporate and high-yield bond holdings. So those are gone. So yeah, I don't worry about the government defaulting. What I care about is what is the Fed's response to the next downturn. They can't go lean lower on the federal funds rate. That's done. That is what it is. There's only one thing left they can do, and that's hammer QE $1 trillion a month or whatever the number is. And there's only one place they can go, and that's out the long end of the curve because there's always a shortage of T-bills. And the banks already told them, don't buy any more T-bills. So what are they going to do? They're going to go out the long end. They're going to hammer that thing down. And when the long end of the curve crashes, it's a massive risk-off event. Investors will flee out of risk assets, go into bonds, and then it'll be rare opportunity to unload into one. Maybe at that point, buy into gold, silver, mining stocks, other risk assets, equities. But it'll be a huge opportunity because nobody is expecting right now that to happen. They all think interest rates should be 5-6%. They don't think they should be at below 1 or near 0.
Now, the Fed Treasury is considered the risk-free asset because the government's not going to default and they're always going to pay it back with dollars. And of course they are, because they can print unlimited amounts of dollars. But what if they pay those back with dollars that they printed, but they're worth half as much when they pay them back because they printed so many? I guess you don't care because you're not planning on holding them. You're just planning on flipping them back to them.
Bingo. At this point, they cannot print money, so that's not a concern. But I'm not. I like to say that I am the bond king today, but there'll be a point where it's time to flee the kingdom as other people wish to seek safe haven here and take over their kingdoms that they left behind. So no, I'm not long term in this. It's just more opportunistic for the price appreciation when we find out that QE actually tightens financial conditions and is going to lead to another recession.
Does the bond king forecast include like some time frames? Is that like over the next 18 to 36 months or something? Or what are you thinking there?
I'm really bad at forecasting. But looking at the data, I think we're much closer to seeing things start to roll over and head lower. The only question will be is how long will it take, or how fast will the economy move down, and then how long will it take for the Fed to respond? Because there's a lot of money that's sitting in risk assets that's not allocated into the bond market. So there's a huge margin for money to move in and drive rates down. That's just not something that most people think because they think inflation is going to drive interest rates higher. But it's really not a great relationship. It's more bond prices will tell you, or interest rates will tell you where inflation is going. And the bond market's telling you right now that in this inflation story, it's not going to persist. In fact, you could even make the case where these higher prices are leading to even tighter financial conditions because of the money being tied up in the commercial banking system due to QE. It is limiting how much dollars are out there for people to actually work with. So yeah, I hope it's not 3 years from now, but I have a hunch that it's sooner than later. Maybe the catalyst is the unemployment benefits going away. We'll see.
Yeah. So long bonds for now. Wait till they jack up. Sell them back to the government. Move into some risk on assets.
Absolutely.
That's the Bond King. The Bond King game plan, the Bond King will eventually go to some other king.
Right. Yeah. Whether it's crypto, gold, silver, mining stocks, it doesn't matter. Whatever you like, I think there'll be opportunities out there. I just don't know exactly which ones. Maybe Bitcoin or other cryptos will go up when this happens. It could. I don't know. But there will be opportunities out there. And you look at the dollar, you look at bonds as deferred dollars. Those are your safe havens and risk off events. That hasn't changed yet. Maybe down the road, but at least for today, that's still in play.
Got it. All right, man. Well, we covered a lot. I think we can probably wrap it up with that, with the Bond King forecast. I know you've been sticking through that. I think we talked about that last time we had you on. So we'll continue to keep an eye on that. Looking forward to seeing you come speak at my event that we're having here soon, which you can tell us a little bit more about how we're going to navigate through that. So I'm excited for that. But other than that, I know you put out a couple 3-4 videos a week, and I'll make sure to link it down there. Anything else you want to draw people's attention to?
No, but I look forward to all meeting everyone at your event coming up in November. I don't have the details yet. I don't know if they're out yet, but I'm looking forward to seeing everyone in Miami. It's going to be a lot of fun.
Awesome. Awesome, Steven. All right. Well, we're going to go ahead and sign it off with that. I appreciate it. Thanks so much.
Thank you.
All right. Hopefully you enjoyed that interview as much as I did. Steven Van Metre does not disappoint. His knowledge of bonds and really the inner workings of this financial system is top level, right? He really gets it. And so come hear more from Steven Van Metre live at my event. There's a link down below, How to Survive, How to Thrive, the Great Reset Agenda. Him, myself, and 15 of my good friends who are experts in their fields to teach you how to build, grow, and protect your wealth, increase your personal and your financial sovereignty. Do not miss it. Come hang out. I'd love to see you there. There's a link down below. I hope to see you there.